Jobs Day, like Bloomberg.
This is Countdown to the Open. I'm Lisa Brownway's in for Jonathan Farrow, just moments away from the start of trading, and you can see a pretty boring market out there as we try to find some sort of direction. S&P futures still clinging on to some gains. NASDAQ basically flat. What we're seeing outside of stocks really might be what's driving this. We have seen a retracement in the increase in yields. We are seeing yields lower, but not by much. They were lower by much more earlier. Euro losing some versus the dollar after showing disinflation, but also a potential recessionary condition in crude just a little bit elevated. One stock to watch at the open is Caterpillar, the company reporting shrinking backlog, signaling demand worries. The CEO saying, quote, "We remain focused on supporting our customers' success and executing our strategy for long-term profitable growth." Abigail Doolittle has more. Abby.
Well, clearly investors not liking this, Lisa, with the stock down about 6%. Its worst day since April of 2022, and it has everything to do with that shrinking backlog. Now, the quarter that they reported on the surface, not so shabby. There was a 15%, nearly 16% profit beat. They put up $5.52 in adjusted earnings. Revenues basically in line, nearly $16 billion. So we're not talking about small numbers, but relative to the backlog, there was a year-over-year decline of $1.9 billion. That is the first since the third quarter of 2020, when it really had to do with pandemic supply issues and the like. So this is a bit of an outlier. And we also have Baird saying that some of the dealer inventories, well, they're continuing to grow, which essentially means that they're not going to have to order as much, showing up in the backlog. Investors nervous that this could continue. This stock now, Lisa, underperforming the S&P 500 somewhat dramatically on the year. That index up closer to 10%. Caterpillar now down about 5% on the year. And again, investors really not liking this quarter at all as the stock continues to slide. Right now at session lows, down about 6.5%. And that is still, I'm waiting for it to come up, that is still at one point it was the worst day since November of 2020. So we're off of those lows, but the worst day since April of 2022.
Abby, thank you so much. Turning now to the airlines. JetBlue reporting a bigger than expected loss due to poor weather and air traffic control issues. The CEO saying, quote, "We're making improvements to drive profitable growth and ensure JetBlue is positioned for success in 2024 and beyond." Isabel Lee has more. Isabel.
Hey, Lisa, the stock is now tumbling almost 13%, and the adjusted loss will be 35 to 55 cents a share. That's much higher than the 25-cent deficit projected by analysts. Revenue will decline up to 10.5% from 2022, also missing expectations. So for JetBlue, they're banking on international travels for their growth in the next quarter. So this just really shows that some U.S. carriers have been hit harder than others. But overall, the industry is just in general grappling with the waning demand, aircraft delivery delays, and parts shortages. And this also comes in the middle of a crackdown on airline consolidation this week, in which the U.S. Justice Department claims that JetBlue's bid for Spirit would limit flight operations. For now, Lisa, shares are tumbling almost 12%, and JetBlue is down around 35% this year.
Isabel, thank you so much. Sticking with earnings, Pinterest jumping on expanding margins and strengthening growth rate. The CEO saying, quote, "We're finding our best product market fit in years. Our users are engaging deeply, and we're delivering better results for advertisers. Evidently, everyone is planning parties and decorating their homes." Ed Ludlow has more. Ed.
Yeah, good morning, Lisa. The stock up almost 14% as it stands on track intraday for its biggest jump since October of last year, 2022. At the open, it was on track for its biggest jump since August of 2022. They're talking about making the platform more shoppable, the investments that they've made in artificial intelligence, driving the user base to make purchases in the e-commerce context based on the images that they're looking at. A beat on the top and bottom line, revenues coming in at $763.2 million, ahead of estimates. Adjusted EPS 28 cents per share. The estimate was for 20 cents. What's most interesting is the monthly active user base. 482 million users, monthly active users, is a record and eclipses the pandemic peak. But then within that is the growth narrative, and that growth is coming from ROW, those markets outside of the United States, Canada, and Europe, which makes up more than 50% of the user base. So they're seeing traction in the rest of the world region, and what they're talking about here is that investment in AI being a key factor in helping them pay off. The stock up 13.5% as it stands.
AI decorated rooms. Thank you so much. Another story in the retail sector. VF Corp falling after the footwear company withdrew guidance for the fiscal year. The CEO saying, quote, "Our transformation plan will improve our brand building and execution while addressing with urgency our top priorities." Such corporate speak this morning. Katie Greifeld, who is my Halloween pair today in orange to my black. What's going on?
It has been a brutal showing for VF Corp. Like you said, shares down about 4% right now after pulling their guidance, introducing that turnaround plan. It's really aimed to cut costs, reduce debt, and really overhaul that Vans footwear brand, where in that specific unit, revenue dropped 21% in the fiscal second quarter, and the company warned that performance isn't expected to improve in the fiscal second half. Now, as a result, they're reshuffling the C-suite as well. Vans President Kevin Bailey going to step down. CEO Bracken Darrell will lead the unit in the interim while they search for a replacement. And of course, all of this comes while you have two activist groups circling the company. So even with these overhaul plans, Wall Street still sees a really tough road ahead. After the numbers this morning, at least 3 banks cut their price targets, 1 downgrade coming from Williams Trading, 2 hold from buy. Shares currently off about 3%. They had been down more than 10% in the pre-market, so some of that loss coming back. But VF Corp shares down by more than 40% year to date, Lisa.
Thank you so much, Katie. Meanwhile, stocks heading for an 8th year of outperformance in a decade. Goldman Sachs believes that will soon end, with analysts writing, quote, "The U.S. equity market now has more concentration risk than other major markets. Investors should increasingly focus less on regional exceptionalism." Joining us now, I'm so pleased to say, somebody with incredible insight, PIMCO's Aaron Brown. Aaron, do you agree that U.S. exceptionalism can only go so far and that it's kind of running out?
I actually disagree with that statement. I mean, you've seen a decade of U.S. outperformance, but I think that's been really justified by the fact that the U.S. is a higher quality index. It has higher free cash flow generation than its European or other developed market non-U.S. peers. And in addition to that, in a market where you're getting, 5-6% yield on cash right now, cash-rich U.S. companies stand to benefit from being able to invest that cash into, decent yielding environments. So I think that the preference for quality, particularly in this type of cyclical environment, is going to continue to outperform. And I think that the U.S. is best positioned on a regional basis to take advantage of that.
There are a couple of questions embedded within this. Number one is, how long can the U.S. ride its tech wave, right? And that's been a big question. There's also this question of whether the U.S. can get disinflation without incurring some more economic pain. Can we start on the latter to begin with? Do you think that that is possible to get that disinflation that the Fed is seeking without seeing the kind of pain in the likes of Europe and elsewhere that's transpiring?
So you are starting to see inflation come down. I think the question really is it going to come down fast enough and far enough in order for the Fed to meet its objective of 2%. I think that you'll likely see, it's probably a safe bet that you'll likely see additional financial condition tightening, at the end of this year and through next year, whether that's through markets itself or through the Fed doing one more interest rate hike. And I do think that that will get inflation down, but it's probably going to still remain sort of sticky in a high 2% range through the end of next year, which is, I think, going to be difficult for the Fed to really engineer any type of accommodation with interest rate cuts. So I do think it's a fairly fine line that the Fed is going to be facing next year. But ultimately, we are seeing inflation come down. I don't think you're going to see significant economic pain in the U.S. You may see some retrenchment in growth, but it's going to be a very low growth, not necessarily severe recession as we enter in 2024.
Given that backdrop, are stocks a bright spot? Is the pain trade for stocks to keep climbing because they are cash rich? They're able to capitalize on an economy that's not sinking dramatically and frankly are in pretty good positions, especially with their tech leadership.
So I think you're going to see real differentiation emerge as we move through 2024. You saw some of that this year, and I think you're going to continue to see it next year in terms of differentiation between the high quality stocks and their lower quality stocks. Right now, stocks are competing against a yield-rich environment on the fixed income side, which is, yielding you, north of 5% on cash. And so that's a difficult environment for equity investors as a starting point. So, for companies that aren't delivering with respect to earnings, with respect to sales, and with respect to free cash flow, there's another alternative out there right now on the fixed income side, and it's a safe haven asset. That said, I think that high quality companies that are able to generate growth and free cash flow will, continue to do well in 2024, because I don't think we're going into, a recession. And if we do go into a recession, it's going to be, a fairly mild one. And so in that environment where you have, slow growth, but not necessarily severely negative growth, stocks that are able to generate, good returns, good earnings are going to continue to do well. So I think, you really have to pick your spots as you enter next year.
As you pick your spots, and it is selective, I'm curious how you're allocating, given the fact that the ballast of bonds has shifted and that the ballast of stocks has become more idiosyncratic.
So I think that, particularly good quality, high, investment grade fixed income instruments, I think should continue to do well. Agency mortgages, I think, look very cheap. Even non-agency mortgages, structured products also look, relatively attractive in this environment, as does high quality fixed income broadly. Some equities, I think, also look attractive, but where we're really staying away from are equities that are really dependent on a easy interest rate environment. Some stocks like the home builders, like consumer autos, have done really, decently well this year, particularly the home building sector, but yet, an 8% mortgage rate is going to really start to bite next year. And so I think that those are the stocks, the ones that are consumer facing, but also highly dependent on easy credit. Those are the stocks I think that are underperform. Broadly speaking, I think the equity market will have sort of low, sort of to flat growth next year in terms of the total equity return. But I think you will see real differentiation between, those stocks that can internally generate its own growth and cash flow versus those that are really dependent on an easy financing condition, which are going to be hurt, I think, even more so next year.
Within the credit sphere, you're talking about some of the more interest rate sensitive on the equity sphere. In the credit sphere, there's been a lot of befuddlement about why we haven't seen more pain. Former Fed Governor Jeremy Stein was quoted in a Bloomberg piece today saying, if you had told me 2 years ago that the Fed would hike by this much in a short time, I would have said that they would leave dead bodies littered across the corporate credit landscape. A lot of people would have agreed. Is that deferred, delayed, or just put off indefinitely?
I think it's a little bit of both. I think, firstly, you've been in an environment with over a decade of super low interest rates where corporates have termed out their debt, and so you haven't seen significant debt maturities coming due over the last couple of years. And I think as a result of that, companies have been able to hold in there. If you look at interest rate costs in the U.S., they haven't increased in terms of the aggregate share of the corporate balance sheet that much, and corporates that are cash rich have actually been able to take advantage of this high interest rate environment and reinvest their cash flow into, higher yielding money market funds or cash funds. And so as a result of that, you haven't seen corporate credit pain. You also haven't seen household pain either, because similarly, households have been able to term out their debt structure through the 30-year mortgage, which is why you're seeing a different outcome in the U.S. with respect to, non-performing loans versus other more interest rate sensitive economies. That said, there's only so long that this can last, and so you are seeing cracks in the levered loan market. You are starting to see some cracks in the floating rate market, as well as the more distressed high yield market. I think that those are going to be more idiosyncratic stories. We don't have a significant debt maturity wall until the end of this decade, and so I think by and large, corporates that are investment grade should hold in and be okay.
Erin Brown, thank you so much, as always, for your insights. Coming up, Apple unveiling new products ahead of Thursday's results.
The issue with tech is that the Magnificent Seven have been talked about so much now. It's almost been primed to fall from that precarious perch. And that's exactly what happened.
Can Apple earnings help big tech get its mojo back? That conversation coming up next.
The issue with tech is that the Magnificent Seven have been talked about so much now. It's almost been primed to fall from that precarious perch. And that's exactly what happened. I'd be very interested to see how the Apple numbers are received. I suggest again there will be a proneness among investors to look for the holes, look for the cracks, look for any weakness, simply because the Magnificent Seven have been priced for perfection.
Tech results continuing to roll out with Apple in focus ahead of its Q3 earnings report. That comes out on Thursday. The company unveiling a new iMac laptop and third generation of its in-house processor line at its Scary Fast event last night, which is fantastically themed. All eyes are on the new M3 chip lineup, which relies on advanced tech to boost performance and graphics horsepower. Joining us from San Francisco, back for more, is Bloomberg's Ed Ludlow. Ed, how much does this really move the dial ahead of earnings in 2 days?
Well, the timing is curious. It was scary fast, by the way, about 30 minutes, the shortest Apple product unveil that I've seen. gain. But of course, nothing that was announced across the new Mac lineup is going to have an impact on the fiscal fourth quarter, which gets announced Thursday. Basically, what we got is a new iMac and 3 variants of the new MacBook Pro, all powered by 3 nanometer M3 chips. It's the first time that any volume producer of PCs has put a 3 nanometer built chip into their hardware, and there's a sort of ascending scale, M3, M3 Pro, and M3 Max, which as you go up that ascending scale has an increased number of CPU cores and GPU cores and performance. And what Apple is hoping on, the outside of the fiscal fourth that they report Thursday, is this puts them back on track in the PC market. Something the sell side's responding to this morning is looking at what's announced and saying, okay, this could drive an upgrade cycle for consumers around the world who either have the Apple hardware that has the M1 processor, the first generation of Apple in-house silicon, or they have the most powerful Intel-powered PCs.
Yeah.
And something that Apple said during the presentation is that their most powerful MacBook is 11 times faster than Intel. That's the battleground. The expectation Thursday, 4th consecutive quarter of overall sales decline, which the market is bracing for.
Well, that's exactly where I wanted to go, Ed. Just quickly here, just to underscore the point, how much is this trying to give some decoration to take the noise off of what they're going to report on Thursday?
Yeah, it's worrying because you have to go back more than 2 decades for Apple to have 4 straight quarters of sales declines. They've been candid that in North America, the PC market and the smartphone market is weak. China was a bright spot in the fiscal third, but the third-party data says that China won't save the day this time around.
Ed, thank you so much. As always, wonderful reporting. Sticking with tech, Apple isn't the only company set to report earnings this week. With results from chip giants AMD and Qualcomm still in the pipeline, Katie Greifeld joining us for more. So far, the story very much, Katie, has been the reaction to some of these earnings, which has been punishing, particularly for anything that's amiss. What are you watching?
Yeah, that's the word to use, punishing. It has been a punishing earnings season so far. We still have plenty of mega caps set to report earnings, and we'll see if they can reset the narrative here, because so far, before we get to Apple on Thursday, we have Qualcomm tomorrow, AMD after the bell today, and this is really a tale of 2 chip giants. You take a look at AMD, and successfully taken on Intel. It's aiming for NVIDIA's fortune with its new AI accelerator chip. All of that has powered AMD to a 46% rally year to date. Then you take a look at Qualcomm, meanwhile. It's been plagued by sluggish smartphone demand, prolonged inventory struggles. All of that has left shares about 2% lower year to date. It's going to be really interesting and important to see how this settles over the next couple of days.
At this point, we've been seeing that those that beat kind of get like a tepid applause, and those that miss see their stocks tank. How much is this even more so for the big tech sphere, the Magnificent Seven, given the fact that those shares have driven the gains so far this year in headline indexes?
Well, that's the thing, Lisa. Investors are really looking for a reason to either justify the rally or to actually resume their buying. And so far, if you take a look at the commentary, if you take a look at the numbers, that really hasn't been provided. And the stakes are a lot higher after we've seen these double-digit rallies and then some from some of these really huge companies.
At this point, Katie, is there one sector that's outperforming, or is it pretty much story by story, company by company, execution by execution?
You know, that's what I've been looking for, and it feels really idiosyncratic at this point, because you have the likes of McDonald's that still have pricing power, for example, and then you take some of their retail peers, and it just doesn't exist. So it really depends on the company, on the C-suite, and really what their actions have been to this point.
Katie, thank you so much. My partner in crime when it comes to Halloween decor. For some of the sector price action that's really getting our attention this morning, let's head over to Bloomberg's Abigail Doolittle. Abby, what you see out there?
Well, Lisa, we have this small loss for the S&P 500 right now, down about 1/4%. Not surprisingly, most sectors are lower, but not a ton of drama beneath the surface, as John would like to say. Tech is the worst sector, down about 0.9%, and this even as yields are lower, so we're not getting any relief there. We also have energy, communication services down. Real estate and utilities, well, because yields are down, those, of course, are the dividend-rich sectors, so those dividends look a little more attractive this morning. Those sectors are bid higher. Now, earlier we were talking about JetBlue, those shares plunging. Isabel Lee, I should say, was talking about it. And the airline index, even though JetBlue is not a part of this index, today and over, frankly, the last month and from July even down sharply, but this month down about 17%. Some of the big airlines down in sympathy with JetBlue.
Costs going up and not able to pass it along to the customers in the same kind of way as places like McDonald's. Abigail, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary. That all day yesterday. Finding a little bit of weakness as the session grows older. A spooky morning on this Halloween. A question of NASDAQ underperforming down 0.6%. Time now for the Trading Diary. What you need to be watching this week. U.S. consumer confidence coming at the top of the hour. Wednesday, FOMC rate decision followed by Chair Powell's news conference and, of course, the Treasury refunding announcement, as well as ADP private payrolls. And JOLTS data, it's really a massive week for labor market data. Thursday, more data, including jobless claims and durable goods. Apple reporting earnings. And Friday, the October payrolls report. Right now, what you are seeing in markets is a fading after the employment cost index came out better or hotter than expected. This was Countdown to the Open. John should be back by tomorrow. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, October 31st. Here are the top market stories we're following for you at this hour. Caterpillar crushes, then cracks. The company delivers a solid quarter, then warns of a backlog buildup. That stock is down 6%. And JetBlue's air pocket. The company lowers guidance, outlining lots of issues from air traffic control to demand to capacity to, this is for Guy, weather. Stock down 15%. So just how scary is your outlook? Company forecasts are eerie everywhere. We're going to look at the spine-chilling problems awaiting us in this quarter with Bruce Richards, Marathon Asset Management Chairman and CEO. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, the outlooks are really not good. And we get data out with consumer confidence. How's it looking?
Is it Halloween? I kind of guess that it probably is. Where's the costume? I don't know, but that's
maybe
for Alex Steele to figure out a little bit later. We do it differently over here.
Of course.
Fireworks night's a much bigger event. That's on November the 5th. Remember the 5th of November. Look, we're looking at a whole series of data which I think really kind of pull in different directions. The ECI, I think, is a real problem, the Employment Cost Index. I think that number speaks to the fact that the labor market is still hot. That's a problem. But as you say, the corporate outlook is certainly rolling over. But if the corporate top line is rolling over, is it the kinds of issues with supply chains and labor that is really going to cause the issue here? I wonder. And I'm wondering how companies are going to adjust to a higher cost environment but a lower demand environment, and I'm wondering kind of that's where we are right now. So ECI hot, we now get the the Conference Board consumer confidence numbers, and they're down but they're up, and the prior numbers revised higher as well. Mike McKee, I guess the Employment Cost Index and a hot consumer number kind of go hand in hand.
Well, I wouldn't call it necessarily a hot consumer number. It was a month ago, a little more so than it is today. We've seen a decline, but not a big one. So consumers sort of hanging in there, but they're getting this kind of uneasy feeling about where we're going. The headline number comes in at 102.6 after 104.3. That's better than what was forecast, but it is not as good as the month prior in September. Present situation, 143.1 down from 146.2, and expectations fall to 75.6 from 76.4. Now, the key underlying numbers that you want to look at with the Conference Board is the payrolls numbers, and right now jobs hard to get, it falls to 13.1 from 14.2, and jobs plentiful doesn't move much, 39.4 from 39.7. So people think this is pretty much the way the labor market is going to go, and that suggests that maybe the ECI is reflecting reality when it shows that wages go up a little bit. 6 months from now, people think that employment is going to be about the same, and that incomes are not going to increase. So the pattern has been the ECI until this time showing slower growth in wages. That's what people seem to expect, at least at this point.
All right, Mike, appreciate that. Thank you very much. We appreciate your tie also, very Halloween-y. It really helps us with our question of the day. I should point out stocks around the lows of the session, so just sticking with that more negative theme, and you're taking a look into the bond market, you're seeing some buying still coming in to the long end a touch. So our question is, how scary does the fourth quarter actually look? As we take into account all the earnings, the consumer confidence, though, is still okay. You have the ECI still okay, but still, do we roll over? The outlook is really what's puzzling everyone, including for central banks. Joining us now is Brooke Sutherland of Bloomberg Opinion. Brooke, you literally read like the majority of earnings reports, particularly in the industrial sector. How scary is the fourth quarter going to be?
I don't think it's going to be, I don't know if I would use the word scary, but it's certainly not going to be super encouraging. I think, Caterpillar is a case in point today that the actual third quarter numbers were pretty good. But a lot of that was driven by price. Where we're not really seeing the strength right now is in the volume side. And that's been sort of across the board for industrials. Where you have growth, it's really supported by these price increases. Now, you can't really have a situation where volume demand is weak and price increases just keep going up. It doesn't work. That breaks down over time. And so I do think
that starts to make you a little nervous about what the industrial demand picture looks like. We're also seeing orders come down. Now, companies say that's destocking, that there just was so much inventory built up during the supply chain disruptions. And while I think that's true, we're at the point where we're now several quarters in the destocking, and at a certain point that starts to look like demand is just not really as strong as it was before.
Let's talk about consumer demand, Brooke. What does JetBlue tell us? Yes, they've got ATC problems. Yes, they've got weather problems. But they've also got a capacity problem here as well.
They do. I mean, they're not alone in that. I think the domestic airlines in general have too much capacity, where they really chased this revenge travel phenomenon. They thought that that was going to continue. It didn't. People went internationally this summer, and then we're really starting to see some of that travel demand taper down as people get back to work, get back to school. We're not seeing that business travel strength come through to the extent that the airlines had hoped for. So during these off-peak travel periods, airlines are really having to discount fares just to get those seats full. That creates a very untenable dynamic, especially as you have fuel costs up, labor costs up, and the operating costs of these airplanes are also up. So JetBlue is really struggling, but they're certainly not alone in this, chasing that demand.
Yeah, Guy, what puzzles me, though, I think, and I was saying this yesterday, is the extent to which you get punished if your guidance isn't great. I mean, how much of this did we not know about JetBlue? I appreciate the Caterpillar outlook was murky, but it wasn't like the worst thing in the world. Like, I mean, so I don't understand how we're factoring this in and how punishing.
But the guidance is the new information. The guidance is the new information, isn't it? The numbers are what you would expect. You can price the numbers in. This is what we expect this quarter. This is what we expect the company's going to deliver. The variable then comes in the guidance. What comes next? And that comes back to the question of the day, the kind of how scary do things come from here? And some companies, and there are more here in Europe, take a look at what BASF's saying today about its structural changes to its business going forward. It is having to make long-term decisions. This is the kind of stuff that I think really does spook investors.
Right.
This is the new information. The numbers we kind of can figure out. The outlook, a little harder.
Okay, but that's different. Like BASF saying that they're structurally changing how they're spending money is different than like talking about backlogs, say for Caterpillar. Brooke, when you take a look at the other companies, other sectors, is it the same kind of story? Like, are we getting punished a lot for that guidance?
Well, I think, I mean, just to your point about the punishment, a lot of these companies were elevated on sort of these expectations that there would be secular growth drivers that would sort of decouple the industrial sector from the broader economy, that would decouple the U.S. from China and Europe. That's now breaking down. And so you had that valuation supported by these ideas about mega projects, reshoring, government stimulus, infrastructure,
which should still all be
electrification.
There,
they should still be there, but it is possible for those secular drivers to be true and to be robust and for there to be an economic cycle. You can have both at the same time, that maybe over the long term we're going to invest in EVs, we're going to invest in infrastructure, but that's not necessarily going to lift all boats at the same time and on a set timeline. We've seen a number of these factory announcements on EVs especially pushed out, delayed, rethought. That just means that those growth numbers need to be recalibrated for some of these companies.
Brooke, where does the pain really come? We are starting to see evidence of a top-line slowdown. But that top-line slowdown is going to meet and JetBlue is a good example of this, is going to meet ongoing labor issues and ongoing labor costs. JetBlue's, they're talking about maintenance issues, lack of parts, this kinds of stuff that they're still having to face as well. So in the middle, you are still being squeezed. So how bad does it get at the bottom when ultimately you factor all of that in? And does this supply chain story and this labor story continue? And if so, for how long?
I think for the airlines, it's not going to get better until you get some serious capacity cuts. And we started to see this a little bit, but it's been really focused on the first quarter and not throughout the rest of 2023. And I think if you want to start to set a floor on pricing stability, the airlines really need to start thinking about what is the appropriate number of planes to be flying for the demand environment that we're in. And I don't think they've made those kinds of aggressive decisions yet. For some of these other companies, I mean, there's a debate about what happens here. I mean, this could be a very shallow recession in the industrial side, where, you know, we then start to see some of the lift from some of these secular themes we were just talking about, especially some of the government spending might start to kick in the back half of the last year. But I haven't talked to anybody that's looking for a V-shaped recovery, because you do still have these lingering supply chain disruptions, especially on the aerospace side. I mean, we've seen Boeing take down their estimates of deliveries for the 737 MAX. We've seen GE knock down its estimate of deliveries for the LEAP jet engines just because those supply chain disruptions are proving so stubborn, so difficult difficult to overcome. And then the labor issue, you don't cut wages. Once you've increased them, you can't go backwards. And what we've seen with, the UAW talks, that's still very much an element that companies are having to deal with. And so I don't think that issue goes away, and so you just end up getting squeezed.
And the lesson, I guess, from the pandemic was don't lay off staff. You lose so much kind of intellectual property, so much know-how when you do that. If you are going into a downturn, and it could be a mild one, you don't want to take that risk. Brooke, that was fantastic. A masterclass. Always appreciate it. Brooke Sutherland of Bloomberg Opinion.
Thank you. Okay.
A masterclass.
Oh, wow.
There you go. That's a gold star for Brooke. Coming up, more insights into our question today. There must be some sort of Halloween equivalent. How scary does Q4 look? We're going to find out next. Bruce Richards, Marathon Asset Management Chair and CEO, joining us in just a moment. This is Bloomberg.
There are a number of sort of troubling things that are going on in the world right now, and it feels like to us there's a bit of a sense of complacency in markets. If you look at equities, for example, you look at the multiples we're trading at, notwithstanding the move up in long-term discount rates on future cash flows, notwithstanding the fact that we've got issues in the Middle East and everything like that, we wouldn't be surprised to see investor sentiment tested at some point.
That was Mark Downing, RBC Blue Bay Asset Management CIO on Bloomberg TV earlier. So that brings us to the question of the day. How scary does Q4 actually look? So we talked about the equity side. Let's get more of the debt macro side. Bruce Richards, Marathon Asset Management Chairman and CEO, joins us. Marathon has over $22 billion in assets under management. Two-pronged question. The first one is general. How ugly does it get? How scary is it?
Scary. Well, happy Halloween.
Happy Halloween.
It can be scary. And so the good news is, GDP's looking just fine, 4.9% last quarter, probably about 2% this quarter. We'll get employment this Friday. Last month it was 336,000 jobs. We're expecting around 200,000 jobs. And so the Fed today, we're going to hear that they're on hold. And so all that is not so scary. But when I think about what really concerns us in the marketplace, and it is a bit scary, and the scariest we've seen this in kind of recent memory or in our lifetimes perhaps, is a war on two continents. That's scary. And the geopolitical problems that Western Europe and the U.S. are facing that we haven't faced since the Cold War, that's scary. And so talking about markets, because that's really the question, it's really those that are highly levered that don't really have liquidity that should be most scared right now. And it starts with CRE, so commercial real estate. And I was just looking at last week's data where, the commercial real estate market can be encompassed, if you want to look at maybe the debt side of the equation, by the $1 trillion of CMBS securities. And the rating agencies, Moody's, S&P, and Fitch, the three of them downgraded on a ratio of 5 to 1, 5 downgrades for every upgrade, the CMBS tranches that they downgraded. That's really scary because you have this $1 trillion wall of maturity and a lot of value that's been crushed. And so if I'm a CRE owner-operator, I have to really focus on that. And for lenders, defend the fort, and for new loans, really high rates. The second thing to focus on, I think, is the corporate sector. The corporate sector isn't quite as stressed as commercial real estate, but when you look at high yield and loans, the highly levered companies, their downgrades are running 2 to 1. And the next quarter, fourth quarter and first quarter of next year, we expect the default rates to really start to spike upwards. And so we can see that doubling in the next 6 months. And the third element of that is the consumer.
He's saying all the answers,
and so the consumers are really, the consumer's really stressed right now, particularly the more leveraged ones, the subprime consumers.
Okay, I've got a cauldron of things that you're now putting all of this into, so I'm going to kind of fish around in the cauldron and figure out what we need to focus on. Let's talk about going concern. You talk about what's happening in the corporate sector, more at the stress end of the environment. When does that going concern issue really start to bite? Is it in Q4 or is it Q1, Q2, Q3 next year?
There's a great deal of the companies in the high yield leveraged loan market that, given EBITDA, is using all of its EBITDA to service its debt, in fact having to dip into their cash balances in order to service debt. And the question is, how many quarters do they have left of cash to be able to service these higher rates? And so we're going to see, come next April, when these audits are coming out, whether you have a going concern issue for some of these companies. And to get ahead of that, a lot of companies are going to be in the marketplace borrowing, and a lot of companies are going to try to, do what they can do, sell whatever they can sell, cut expenses, but that's a certain cohort of the high yield market. I think generally speaking, 90% of the companies in this sector are just fine. You want to enjoy those higher coupons, but for the 5 to 10% of the companies that are really stressed, they're burning cash, it's a real concern, and you'll have a going concern. And for those companies, that's where you'll really see default rates start to spike.
Well, that's such an interesting point, because if you take a look at, say, the Ford equity, for example, I mean, it's up a little bit today, but man, that chart is ugly. But then it just gets upgraded to investment grade from high yield.
Yeah, so Ford we like. We've been buying Ford. Great company. But, you listen to the UAW's negotiations of 25% increases, and Fain, negotiated a pretty good package from the big three. And I think he, joking around, said to the UAW that I think we squeezed all the profits, all the earnings out of the big three here to negotiate this package. And so what you see is the equity's down 33% since the summer, despite being up today. It's down 20% year over year. Meanwhile, the high coupon bonds are up 10% year over year, and that's what we've been buying. And you have $40 billion of this debt that was junk that just got upgraded just in the last 24 hours to investment grade. So Ford's a credit, and it speaks to a lot of what we're seeing in the equity markets versus debt markets, where the credit is a much better investment than the equity risk. And if you look at like the S&P 500, 900 days ago, it's unchanged versus today. The Russell 2000 versus 1,400 days ago, unchanged versus today. Meanwhile, there's really good returns to be made in credit. 8, 10, and 12% coupons and cash flow.
Bruce.
Yes, Guy.
Do you think, though, that the Treasuries are going to... The benchmark here is the Treasury market, right? Do you think 5% is a reasonable number? Could we get to 6? Could we get to 7? People are talking about those kinds of figures. We're going to get the refunding operation very, very soon. But you've got a situation where government spend looks like it's not coming down anytime soon. In fact, if we see automatic stabilizers, etc., kicking in, it could get even worse. Isn't there a danger that yields go significantly higher from here, that you could get 6, 7% in the Treasury market? And I'm wondering where that leaves your credit market.
We've been telling our clients, and I've been telling a lot of folks, that inside of 5% on 10-year notes, inside of that rate, 4%, 3%, 2%, that we'd be short. we recommend you short your benchmark. At 5%, I would be neutral. Behind 5%, I'd be a staged-in buyer. Do I think Jamie Dimon's right and we're getting the 7% 10-year notes? No, I don't think we get there. I think he said that for emphasis, that rates are going to be higher for longer and have to move higher given these deficits, and to alarm everybody as to the staggering level of deficits. So, look, we're getting the quarterly funding today. 3s, 10s, and 30s will be announced, and we'll see where we come out. But over the next 6 months, we'll probably have to issue about $1.6 trillion in treasuries. That's only in 6 months, just like we did in the last 6 months. So when you talk about these $2 trillion deficits, and it used to be for years and years a $1 trillion deficit, all of a sudden it's a $2 trillion deficit.
Yeah, and interest payments don't help.
And the interest payments don't help, and the government's spending more and more, and they're not controlling what they're spending. And, you know, the government really needs to go on a diet, and what they need is a massive dose of Ozempic. They need to tighten that belt. Stop spending as much as they're spending, because they're leaving it for the next generation. And while you and I might be thinking about this quarter or next quarter, you know, rates being higher, but it's not a credit story for the government. Over the long run, we're leaving this big problem for the next generation.
So this sounds like I don't want to take duration risk, because the government's definitely not going to be taking Ozempic.
Well, I think behind 5%, you can start to, you know, be neutral your benchmark, be neutral your benchmark of duration. But what I would say is my preference is cash, but cash is only one day, and it can go away the next day. And so you want to lock yourself in maybe to something a little higher yielding, and there is where we like floating rate debt. And, you know, 5-year, 7-year notes that have these higher floating rates, and that's our preference, is to be short duration, not be afraid of duration when you're behind 5%, but be short duration and to own a bit of duration. And so if we can own duration and lock it a 10% rate for 5 years or 7 years, we want to do that. And that's a really good investment. So we kind of like longer duration that's cheaper than 5% in terms of the base rate, as long as you're getting that 10, 12% on, you know, on the bonds that you're buying. And then the floating rate side, not taking the duration risk and avoiding those risks that are going to lead you down to default, because there's going to be a big cycle for defaults and restructuring debt. But what you want to do on the performing side is stick with, you know, your safer floating rate leverage loans.
Can I just talk to you about vintages and just kind of figure out exactly, a lot of people are moving into the private space right now, Bruce. Do you only want to buy private equity, private credit vintages that happened after the rates reset? If you bought anything before, aren't you ultimately going to end up being in trouble? So the only vintages you want to buy are after the reset.
Well, I think the vintages of today are going to serve you very well, because you can underwrite to this higher rate environment and enjoy the higher rates as well. And I think that rings true of credit as well as private equity. Now, I think credit is getting paid a much higher rate of return relative to private equity, relative to history, and relative to risk, most importantly. So we're very favorably inclined to be in private credit, and I think private equity investors probably have to look at slightly lower multiples and slightly lower IRRs. As to your question, as it relates to vintage, you know, because there are a lot of evergreen structures that are out there, and a lot of money was spent, and the bubble period was really Q2 of 20 to Q2 of 2022. And so for that 2-year period of time, if there were a lot of investments that were made during that period of time, I just think your IRRs will be significantly lower than what was originally underwritten or what was in expectations.
Has the market re-rated for that at all yet? Or when does that moment happen?
It's not that it hasn't re-rated. I think people are starting to get a handle on this. I don't think that you'll see the realizations of what this means for a few years out, because these are long-term structures. But certainly if you're in a liquid structure, in an evergreen structure that was that vintage, you might want to think about moving to a more current vintage. If you can seize that liquidity and deploy in the more current vintage. I think that would be a smart thing to do if you have liquidity. But most of these structures are locked up where there's an investment period, there's a harvest period, and so you're in that investment, and you'll just see, you know, your 3 multiple be a 2, or a 2 multiple be a 1. Your 15% IRR maybe be an 8 IRR or 10 IRR. You'll just see lower returns and slightly lower multiples for that specific vintage. And you know, And I think what's important for most institutions is you don't try to pick your vintages. You just keep on re-upping for the next vintage, the next vintage, and they'll all average out. And alts are the way to go. And I think that whether it's democratizing for the retail investors in high net worth or the institutional allocations, alts have served your allocation model quite well over a very long period of time.
Bruce, are these resources going to protect it? A lot of people got very rich as a result of low interest rates. You saw huge asset price appreciation. We're now going into a world for higher for longer. QT's tightening everything up. The world is changing. We are going to have to adjust. How should people that have done very well in the prior period protect their assets in this next period? How should they be thinking about it? If you're in the wealth management business, are you now in the wealth protection business in reality, or do you think you are going to be able to make a decent rate of return commensurate with the prior period in terms of asset appreciation?
I think it's an adjustment of a portfolio. I think on the margin, moving dollars away. You don't want to trade equities per se, but if you've been over-allocated equities, if you have a year like this where you've been well-positioned and the S&P's up and NASDAQ's up, rebalancing at the end of the year, because now you have extra dollars that you've made as a part of that portfolio, and rebalancing to credit and fixed income, I think will serve you well. And so I think it's more of a balanced portfolio. If you look at a 60-40 model, for instance, where you're 60% equities and 40% in fixed income, that hasn't served you well. You're down over the last 2 years on that model, 60-40. And so what is the right model? Is it 60-30-10? No, I think it's more like, I don't know, 30-20-40 or 40-20-40? Because alts have so much outperformed fixed income and equities. I think everyone's got it wrong. The question is, do you have the liquidity for that? So when you look at the big endowments, you look at Yale University and these big university endowments, they're 50, 60, 70% alts.
Right. That's going to be something too.
So I think moving more capital away from equities to the credit side right now is the thing to do.
We got to go. Bruce, thanks a lot. Bruce Richards, Marathon Asset Management Chairman and CEO. That was a call. This is Bloomberg.
about an hour into U.S. trading session. On a headline level, not that much is happening, but some of these stocks are getting hit and hit really hard if you're looking at their guidance. Abigail's tracking some of the moves for us. Abigail?
Yeah, well, here's the headline level. Not a lot happening, and it seems as though investors are consolidating yesterday's gains, trying to figure out which way to go after yesterday's big up day, the best day for the S&P 500 since August. But the index is below that 200-day moving average, so a real tug and pull between the bulls and the bears right now, not resulting in much of a move for any of these indexes. The Nasdaq 100 down a little bit. The SOX, after falling pretty dramatically yesterday on semiconductors results, not down as much today. Russell 2000 small cap up just a little bit. Now, one reason to think that stocks could have continued the gain, Bank of Japan really was not as hawkish or tight as had been expected. So we have this big rally for dollar yen, meaning the haven yen goes down. Yet the dollar yen is still below the last peak we had earlier this year, which suggests there's technical reason to think that we could see a pretty significant slide ahead. What would that be? It doesn't appear to be the BOJ right now. Maybe it would be a haven bid. As for some of the big movers beneath the surface that Alex was talking about, first let's take a look at what's moving to the upside. Arista Networks, the cloud company, up 11%. They beat. Morgan Stanley upgraded the shares to an overweight. We also have Tesla up 1%. So many down days recently, down pretty sharply from the July peak. But today investors choosing to send Tesla higher. To the downside, though, NVIDIA down 3% ahead of earnings. There is a report out saying that there could be the Wall Street Journal talking about the idea that $5 billion worth of their China sales, that there could be some wobbliness there. So investors a little bit nervous, especially given the fact that the stock is up, last time I saw, more than 200% on the year on the AI potential. And then Apple, this is one of the big events of the week. The Fed tomorrow and Apple on Thursday, down 0.7%. They're looking at a fourth quarter of decelerating revenue. Profits are expected to grow. The chart, the technicals, well, it suggests that there could be some more weakness to the downside. That doesn't mean that it has to do with the quarter necessarily, but it could be. This is a weekly chart, and you can see the step and stairs pattern on its way down toward the 100-day moving average. This entire area of congestion, though, Guy, it appears as though it is likely to break to the downside. It is already breaking to the downside. The weekly RSI, that points it all the way down toward that weekly 200-day moving average. You can easily make the case here on Apple for a move down toward 140. That's a greater than 25% fall from the July peak.
That would hurt a lot of people.
Yeah.
And would certainly have a fairly big impact in terms of the index levels as well. That's a scary thought, Abigail. Thank you very much indeed this Halloween. Let's talk about what is happening in the tech landscape, because there's some pretty scary thoughts out there as well. Though this morning, it looks beautiful and serene in San Francisco. It is, 32 minutes past the hour, time for the startup. Top tech stories from the Bay Area and beyond, Silicon Valley, starting its lovely morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, Tesla, I was just talking about Apple being under pressure. Tesla's under a bit of pressure as well.
Yeah, on an extrapolated basis, I just glanced at my screen. I think it's up more than 1% in the session. But the point and what Bloomberg's writing about today is that since October 18th and kind of post-earnings, it's a stock that's down 20%. And, something that the three of us have talked about a lot is this interest rates showing up in the real world? Is this interest rates kind of showing that those early adopters for EVs have been and gone, and that the everyday person who's confronted with a choice to buy an electric vehicle is saying, not right now. And, broadly, that in line with demand is the question the market's posing right now. But Tesla's still up more than 60% year to date when the S&P 500's up 9%, just saying.
Well, Ed, I was going to say also, Tesla doesn't have the same kind of labor issues that, say, Ford, Stellantis, and GM do because of the UAW and have an increased worker pay in the same capacity. And as Brooke was talking about at the top of the hour, just because it's taking longer to get through a structural shift doesn't mean that structural shift isn't there.
Yeah, and, the retail investors, those kind of Tesla diehards, that are customers and holders of the stock are in full voice on social media right now saying, this is just a 2-week period in time, come back to me in a year and see how that looks. Yeah. And ultimately at earnings, Tesla still reiterated guidance it will, do 1.8 million vehicles this year. It's still the clear market incumbent. It's just that they used price cuts as a lever to unlock pockets of demand, and then Elon Musk really emphasized the rate environment as being the issue. So, when does that stop being a problem?
Abigail, just talking about Apple.
Sure.
The technicals maybe point to a difficult picture ahead. Scary, yeah. Scary. We can use that word today.
Totally.
Ed, just put the products that we've just seen in the context of the numbers we're about to get.
Well, the products that were announced last night are going to have nothing to do with the fiscal fourth quarter results that Apple will announce Thursday. The sell side is really positive. You know, new iMac, 3 variants of the Mac Pro, computer processors built on 3 nanometer, the first company making volume PC to do 3 nanometer. And yes, they think on the sell side this will spur an upgrade cycle from people that have the first generation of Apple Silicon MacBooks and those using high-end Intel, and the performance of this latest Apple Silicon against the best Intel, it's 11 times faster. So that's good, but it's not going to show up Thursday, and we're on course for a 4th straight quarter of top-line decline. So
yeah, but Ed, you know,
scary.
Well, yes, but what we're seeing with certain companies is that the third quarter may be okay, and I appreciate for Apple, the third quarter actually may be dicey, but it's the guidance and sort of the outlook and how murky that is, it seems to be really moving the stock. How uncertain do you think that's going to wind up being for Apple?
Well, it's going to be interesting to see the specific soft, because it was commentary from the CFO and CEO on the call that really was the guidance, matches with the third-party data. They guided that China would be good going into the end of the year, right? And China in the fiscal third quarter or second calendar quarter was the bright spot for Apple. And yet in the first 30 days since they released the iPhone 15, the third-party data shows that sales are down high single digits versus the same 30-day period a year ago when they released the iPhone 14.
Yeah.
So what Apple told us and what we've got so far in the last month or so contradict. Where they net out, the market's going to pay close attention simply because of the ripple effect of Apple's weighting at an index level and its footprint globally.